A group of shareholders is calling on Reitmans, the clothing retailer, to address what they say are governance concerns, and they're also concerned about what they call a stagnation in shareholder value. For one thing, the dissidents want the removal of 2 directors, the collapse of that old dual-class share structure. We're joined by one of those shareholders now, Jesse Gamble, Senior Vice President and Portfolio Manager at Donville Kent. Thanks very much indeed.
Oh, thanks for having me.
So you say you're part of a group that holds more than 30% of Reitmans shares.
We currently have support of over 32% of shareholders of the company, and we expect by the AGM of next week for that number to be even higher.
And Donville Kent, you own between 6 and 10%?
Under 10%.
Okay.
But we own a significant portion as well, yeah.
What's your basic beef about Reitmans right now?
So one I'll say is the actual operating company is phenomenal. So you go to the stores, this is an RW&Co shirt. I wear the shirts, the sweaters. Mom grew up going to Reitmans, buying the clothes. It's a very good value, very good quality. Okay. It's a great storefront. We don't have issues with the operating side of the business.
Okay.
They're doing a great job. 08, 09, they remained profitable. They did great. All that type of. What we're concerned of is how is the board handling the business on the governance side. So there's lack of independence. There's some of the board members don't own any shares at all.
What?
They've been in there for years.
They don't own any shares?
They collect their $70,000 to $100,000 a year, but they don't own any shares. Or some of them own 2,000 shares or 4,000.
Doesn't the TSX even have a minimum requirement?
Well, so the Canadian Coalition for Good Governance has a whole list of things that how a company should be operating.
Okay.
And they don't. And why? There's multiple questions of this of, it's just, why is the board operating that way? And we think there's a lack of independence and there's the lack of proper incentives, right? Why rock the boat if you own shares? So you don't care what the share price does, but you're collecting your fees every year, right? Or if you're not truly independent from the family, from the company, then it's not run, in our view, in a correct manner.
And their brands are Reitmans, Penn or Penningtons, and which is for the larger size customer, and then RW and Company.
Yeah, and RW and Company is where they're seeing a good amount of growth. So so they appeal to both women and men at that store. And again, if you go to the stores and you look at the products and there's even there's stories of you look at how they're quadruple sewed on the buttons versus some of the other stores that are even trading at higher multiples and have more expensive products. They're not as high quality. It's a good product at a good price. You can get good sales. It's a good store operating level company.
Okay. It's
the board level where they're not. They need to uplist to the TSX. They need to get analyst coverage. They actually need to care about shareholders, all shareholders. The board has a fiduciary duty to all shareholders, and we think that's where there's that gap that we're trying to fill here.
Is it a family-controlled company?
Correct.
And they own the multiple voting, I guess.
So there's non-voting, and then there's voting, and they own a majority of the voting.
Right.
And so it seems like the board doesn't, in my opinion, care about all the other shareholders. None of this stuff goes to votes. None of anything that we've said. You're not getting constructive conversation around it. And a lot of those board members are the same ones that sent that company from having close to 1,000 stores and dwindled. Then COVID hit. They go in CCAA. It's the same board members that made the same mistakes. So when they say, "Oh, it's a great board with good expertise," well, that expertise is what drove them to CCAA. When a lot of other retailers didn't have to go through that process, right?
Sure.
So they went through CCAA. They were able to write off almost half of all their debt outstanding. So their debtors didn't get, they got 50 cents on their dollar. Then after CCAA, they start to do well because now they're only operating their profitable stores. They shut down all their unprofitable. They're operating all their profitable stores, which is great. But then they start paying out bonuses. And the chairman has close to $100,000 car allowance and makes close to $1 million. It's something just needs to be done at that level. And because we actually believe in the company and the products, that's why we're in there, because we're fighting. It's close to a 100-year-old company. Canada doesn't have many of those left, right? We just lost Hudson Bay.
Yeah.
It's a Canadian success story. It's a Canadian company. It's a great company. but it's not being managed the way it should be.
One of your sources of discontent is the fact that it moved from the TSX and the restructuring to the venture exchange.
So they had to, part of that CCAA process, the TSX kicks them off. But everything is in place except for what's called a Cotail clause. So in the 80s, I believe, the TSX said every single company that has dual class shares has to have a Cotail clause, which is both shares get treated the same in the sense of a takeout or something like that, where there's not preferential treatment. But they were grandfathered in because they've been listed for so long. So for them to uplist again, they need to put that in place. And the only reason, again, in my opinion, that they wouldn't want to do that is if they were looking to get preferential treatment, which they shouldn't. Like, all shareholders should be treated the same. Like, that's how our capital market should work. And that's why the Cotail clause was mandated for a reason.
We're showing a big return on the stock over 5 years, but that's distorted by the restructuring.
Yes, if you put a 10-year, it doesn't look good.
Yeah, maybe we can throw up the old 10-year because this stock at one stage traded north. I hope this is not apples and oranges, but this stock traded at one stage north of $22. You'd have to go back to 2006 for that.
Yeah, and that's when they were getting close to, it was like 1,000 stores and more banners and that type of thing. And then they took on too much debt and opening stores that weren't profitable, that type of thing, right? But now they're operating, again, profitable stores. They have zero debt. They have a ton of cash. They own a ton of real estate. They own their warehouse. They own their office building. They own land beside their warehouse. Like, there's a lot of value there. And that's what we're saying. There's a lot of value that shareholders should be rewarded for, and they're not because of that disconnect of what's happening at the board.
Stephen Reitman is the chairman. Have you heard back from him? Have you had discussions?
So I've had discussions. We started going back and forth with him, I believe, in the end of 2023. So I've met with him, calls with him a couple times, but now they're, in our opinion, again, they're kind of head in the sand at the moment. We're looking for constructive, talks of this is why we're not getting reasons of why not to do certain things. So again, it's frustrating.
Thanks very much. We'll get in touch with Reitmans and try to get their take on it. But that's a really interesting story, some interesting governance issues you're raising. Thanks very much, Jesse.
Yeah, thanks for having me.
Jesse Gamble, Senior Vice President and Portfolio Manager at Donville Kent.